Your next module is Financial Decision Models Part 1, and we have 3 subunits within this module: cash flow related capital budgeting, discounted cash flow model, and the net present value method. So let us first discuss cash flow related capital budgeting. What is capital budgeting? Capital budgeting involves long-term investments, long-term projects that will affect many years into the future. So capital budgeting is a process of evaluating and finally selecting which long-term project should we take. We need to consider certain cash flow effects because that's the starting point of capital budgeting. There will be some direct effects of capital budgeting: the direct cash paid in the future or the direct cash we will receive because of the project. So direct cash effect means the cash out versus cash in. And indirect effects mean there are certain non-cash items like depreciation. They are non-cash items, but they have some cash flow impact, like the depreciation tax shield. We'll discuss this in our subsequent slides. So indirect effect means the effect of depreciation tax shield. Direct effects mean the actual cash going out, the cash received, and the net effect is the sum of or the net of the above two. So depreciation is a non-cash expense taken as a tax deduction. Depreciation reduces the amount of taxable income because, of course, depreciation is a tax allowed expense. Consequently, the related taxes. So the reduced tax bill resulting from increased depreciation expense associated with the new project decreases cash paid out because of the depreciation tax shield. We'll discuss this in our subsequent slide. This type of effect is termed as the indirect effect or the tax effect of capital budgeting. Next, stages of cash flows. First, at the inception stage. At the inception stage, when the project is about to be started, we need some capital investment, large outflow. We might require some working capital. So initial cash flows or the inception cash flows, these are the cash flows required at the start of the project. You might need some additional investment in receivables, additional investment in working capital. So this is called the cash flow at the inception. Then, yes, there is one very important point must be noted, that if your working capital requirements increase because of the new capital project, so it's going to be an outflow at inception. But sometimes, in very rare circumstances, there might be some decrease in the working capital because of this new project. So that decrease in working capital would be considered as an inflow at the inception. So remember, if there is a requirement of $100,000 at the start, it will be a negative outflow at year 0, T0. And if the working capital will decrease because of this project, that, let's say, by 50,000, then this 50,000 would be added to the initial cash flows, right? Okay, now, it is very much possible that your new project might require some disposal of your existing asset. Maybe an asset that has a book value of $10,000. It has to be sold for just $2,000. Right? So no doubt you will receive this 2,000 cash flow, but you must also consider that there is a loss on disposal. $10,000 was the book value, 2,000 was the disposal proceeds, so 8,000 is the loss on disposal, and this will attract some tax savings for you. You will have to pay less tax because of this loss, and this would be 8,000 or 40%. We'll discuss these numbers in detail. So there will be some asset that might be disposed at inception, so you must consider the disposal proceeds together with any tax effect of loss on disposal, or let's say it could be gain as well. Let's say this $10,000 value of the book value of the asset, let's say if the asset is disposed at $15,000, so no doubt you receive $15,000, but since there is a gain of $5,000, this gain would be taxable at the rate of 40%, so that means this 2,000 would be outflow. So there will be some gain at disposal or gain or loss on disposal, and both gain and loss must be accounted for on after tax basis. So these are the cash flows related to the inception of the project. Then there will be, let's say these are the net cash flows required at the start, called T0. Then there will be some regular cash flows received on regular basis or quarterly basis, or mostly our capital projects will involve yearly cash flows. So there will be some regular cash flows on every year, let's say from T1 through T5, T1, T2, and so on up to T5. So the regular cash flows after taxes, the net cash flows, these are called the operating cash flows. net operating cash flows after taxes. And of course, there is an impact of depreciation. We will discuss this, how we treat depreciation tax shield in our subsequent slides. So operations mean the cash flow that is received on net basis every year. It could be the same amount like 10K, 10K, 10K every year after adjustment of depreciation and taxes. It could be different, like 10,000 at the end of year 1, 15,000 at the end of year 2, and so on. So cash flows can be the same or they may vary. And then finally, the last stage of cash flows is the disposal stage. This is the stage where the project will complete its life. So we may have to dispose of the asset. Remember what we did at the inception, there was gain or loss on disposal. It must be considered on after-tax basis. Similarly, when we dispose the asset at the end of the life of the project, there will be an inflow on disposal, and this disposal might result in some gain or some loss. So we need to consider the gain and loss on after-tax basis as well. And of course, the working capital that you invested at the inception, this working capital will be recovered at the end of the project. So remember, you have to take care of all the cash flows at the inception stage, at the regular cash flow basis on every year, at the end of every year, and finally the terminal cash flows, the cash flows at the end of the project. Now the next important point is, how do we calculate the regular cash flows from operations on a yearly basis? Because the calculation of cash flows at inception and disposal, they're pretty straightforward, but there are some twists that you might need to be aware of when you calculate your regular annual cash flows. There are two methods we use to calculate our annual cash flows. In the first method, you start from your net income, and to this net income you simply add your full depreciation expense. This is the first method. It will give you the cash flow on a yearly basis. Net income for the year and add back the full depreciation expense. This is the first method. Alternatively, what you can do in the second method, you can calculate after-tax cash flow on yearly basis. Remember, after-tax cash flow. And to that after-tax cash flow, you just add depreciation tax shield. Now, I will explain what depreciation tax shield is. So, in the first method, take net income plus depreciation expense. In the second method, you can take the after-tax cash flows, and to that you add depreciation tax shield. Let me explain what is depreciation tax shield. Depreciation is a tax allowed, or what you call the tax deductible expense. Means it is a valid expense from tax point of view. Which means if you charge depreciation in your income statement, you will be allowed this amount as a deductible amount, and you will have to pay less tax. So which means if we are moving from cash flow point of view, we must add back the depreciation tax shield, which is the income saved by the depreciation, because the depreciation is a tax deductible expense. Let me explain the idea with the help of numbers. Let's say your annual cash flows are 40,000. So you must charge depreciation against this cash. Depreciation is 10,000, so it means your pre-tax income is $30,000. You have to pay tax at the rate of 40%. So this is your pre-tax income called the operating income. You pay tax at the rate of 40%, and 40% of 30,000 is going to be 12. What you get is net income, which is 18,000. Now I just told you a little while ago, you take your net income, which is 18,000, and to this you add your depreciation expense, which is 10. 18 plus 10 gives you 28,000 as after-tax cash flows. This is the first method. You first calculate your net income and add back full depreciation expense, right? This is your net income after tax, and you add back the full depreciation expense. Second method takes after-tax cash flow. This is your annual cash before tax. If you need to convert it on after-tax basis, just multiply it with 1 minus tax rate, 1 minus 40%. It will be converted into after-tax basis. So this will be 60% of 40,000. That's 24,000. Now we are moving from cash flows only. In this case, you are going to take the depreciation expense, which is 10,000. Since it's a tax allowed expense, tax deductible expense, take just the percentage of this amount. 40% is the tax rate. Depreciation expense multiplied by that tax rate. This is called the depreciation tax shield. This is called the depreciation tax shield. So if you add this 4,000, the amount would be the same, 28,000. This is the after-tax cash flow, right? Remember, what is depreciation tax shield? It is depreciation multiplied by tax rate, because this amount is saved because of the depreciation tax deductibility. Depreciation shields this much of amount of tax that you may have to pay, because the depreciation is a tax deductible expense. It's a tax allowed expense. So depreciation shields your income from taxes by this amount. So whether you take after tax cash flows plus tax shield, or you take net income plus full depreciation expense, the result would be the same. It is entirely up to you whichever method you want to follow. Totally your choice. And of course, it depends a lot on the question, what information is given. So accordingly, sometimes you may have to use this method or elsewhere this, but you need to know both. Now, here's a good example that will distinguish between your initial cash flows, the cash flows at inception, your regular cash flows, the annual cash flows, and the terminal cash flows, that is at the cash flows at the end of the project. The divisional management of, what's required? Let's proceed the requirement. Calculate the cash flows at the beginning, at year 0, T0, and the cash flow for year 1 to 5, and the cash flow for year 6. The divisional management of Carlene Company has proposed the purchase of new machine that will improve the efficiency of operations in the company's manufacturing plant. The purchase price of the machine is $425. This is clearly outflow at the start. It will require $10,000 for shipping, and putting the machine into service includes $10,000 for shipping, $15,000 for installation, and $6,000 for initial training. All these are initial outflows. Relevant minus $10,000, minus $15,000, and of course minus $6,000. The negative sign indicates these are the outflows. If you add all these, it's going to be a total of $456,000. So this is the cash flow at T0. That is the year 0 at inception. Next, annual cash flows, the regular cash flows. Carlene expects the machine to last 6 years and to have an estimated salvage value of $7,000. The machine is expected to produce 4,000 units a year with an expected selling price of $800 per unit. Prime cost, that is the direct material and direct labor, is going to be $750. What you should do, take the selling price, deduct your prime cost, material and labor. That means the contribution, the manufacturing contribution per unit is $50. So if you sell 4,000 units every year, 50 times 4,000. So for that's going to be 200,000. For year T1 to T5, for 5 years, you will receive 50 multiplied by 4,000, 200,000 of cash. These are the before tax cash flows. You must pay tax on these cash flows at the rate of 40%. So the tax on these cash flows at the rate of 40%, 80. So what you get in the net is 120. Now to this you need to add the depreciation tax shield. How do we calculate? This is the amount of the asset, 456,000. 456,000 is the initial recognition of the long-lived asset. It will last 5 years. So when you divide it with 5 years, this will give you the annual depreciation. Annual depreciation multiplied by the tax rate, this will give you the tax shield. Annual depreciation tax shield. So this would come out as 36,480. You need to add this back, 36,480. This is the depreciation tax shield. What I've done, I've used the second method in which we take the after tax cash flows and to that we add the depreciation tax shield. If we do that, the annual cash flow would be 156,480. Let's say if you don't want to go with this method, let us just do it so as to make sure you understand both methods. Let's say I want to go with the conventional net income approach, and let's see, do we get the same answer here? Now, what we will do, take your revenue, which is $200,000 every year, right? This is your revenue. From this, deduct your depreciation, this which is going to be 456,000 upon 5, that is 91,200. That's your depreciation. So deducting this depreciation from your revenue gives you 108. This is your operating income, 108,800. That's your pre-tax income or your operating income. You must pay tax on this amount at the rate of 40%, which is 43,520. So deducting this amount from 108,800 gives you 65,280. This is your net income. Operating income less taxes, 65,280. This is your net income. And to this net income, you add back the depreciation expense. If you remember, 456,000, the total amount of the asset, capitalized divided by 5, that is 91,000. So if you add back the depreciation expense in total to the net income, you should get your cash flows, which is exactly the same, 156,480. So either net income plus full depreciation expense or after tax cash flows, and to that we add depreciation tax shield. What is depreciation tax shield? Depreciation multiplied by the tax rate. So in both cases, the cash flow would be the same. Finally, the terminal cash flows, the cash flows at the end of the project. Now, here is an important point to note that the machine will last 6 years as per your accounting estimates, but tax depreciation will be computed under the accelerated straight line rule for 5 years. That's why we use the 5 years basis, because when the rate or when the estimated life is given under the tax laws, we ignore what is given under the accounting convention. So it's going to be 5 years. That's exactly what we use. And it says that there will be no consideration for salvage value, means at the end of the life of the project on year 6, there will be no depreciation tax shield. This is an important point. Now we need to find out the cash flow at T6. So you will have the same mechanism we discussed a little while ago, but the only difference is there is going to be no depreciation tax shield. There will be no adding back of depreciation, because there will be no depreciation in the 6th year as per the 5 years policy under the US tax laws. So what you will have, you will have your revenue, and you need to pay the tax on revenue at the rate of 40%, which is 80. So this will give you, this is the cash flow at the end of the project. So it's going to be 120, no depreciation tax shield. And finally, what you will be having is the disposal proceed of the asset. If you just look at this, it says that at the end of the project, the asset would be sold at a price that might given somewhere here, $7,000. The asset would be sold at $7,000 at the end of year 6. So you will surely receive $7,000. But since the whole of this is gain, because the book value is 0 at the end of the project, no salvage value for the tax purposes, the whole of this amount is gain, and you must pay tax on the gain. Tax on the cash flows have already been paid. So 7,000 times 40% is going to be 2,800. So deduct this. There are two ways. Either you simply take this 7,000 after tax basis, just multiply 7,000 with 1 minus tax rate. That will be 4,200. Else, you write the full cash flow and then deduct the tax later. Nonetheless, your result will be the same. So let's net it up. 120 plus 7 less 2,800 gives you 124,200. This is the cash flow at the end, or the terminal cash flows. Your next subtopic is discounted cash flow analysis, DCF. What is DCF? Let us continue with the previous example. We just discussed that there were some cash flows, your T0, T1, T2, T3, T4, T5, and T6. So these were the cash flows we just discussed a little while ago. This is your initial investment at the inception of the project, and these are our annual cash flows for the coming 6 years. DCF valuation method, it simply calculates or incorporates the time value of money concept and brings these future cash flows into the present term. What we do, we calculate the present value of your investment, which is 456,000, because this is at year 0. So it's right now its present value is 456,000. And we bring back all these future cash flows in the present term. So total of these will give you the present value of inflows, and this is the present value of outflows or your initial investment. We compare present value of inflows with the present value of outflows, and then we decide should we go ahead with this project or not, right? So calculation of the present value of your investments and the present value of your future cash flows, this is called the DCF valuation, and then we'll discuss how we decide should we go for this project or not, because it's a very meaningful idea that if I have to make an investment of 456,000 now and I will receive many cash flows in the future, so why don't we just bring them in the present term, and then it will be much easier for me to decide that should I go for this project or not. Like let's say just giving an example. If the present value of the future cash flows from T1 to T6, let's say if it is $500,000 discounted at a certain rate, we'll discuss. That means if I invest 456,000 now, at this very moment, the future cash flows will be equal to $500,000, which means I will receive more than what I invest. To the contrary, let's say if the future cash flows discounted at a certain rate, if it happens to be just $400,000, that would mean if I invest $456,000 right now, the future cash flows in the present terms will be just $400,000, means I will have to invest more, I will get less in present terms, so this project is not desirable. We'll discuss this concept further, but that's what DCF is all about. Objectives of discounted cash flow model in capital budgeting. We use DCF model for evaluation. We will evaluate our capital investment project, that should we invest in this project or should we not. What we do, we calculate the present value of our inflows and we compare them with the present value of outflows. And this will help us decide that should we invest and should we not. We will discuss this in detail in our coming slides. Now, we just discussed a little while ago that we have to discount our future cash flows at a certain rate, at a certain discount rate. What that discount rate would be, we will have to take maybe the rate set by the management, 6%, 9%, whatever the rate they have selected arbitrarily. Or it is possible that we might use the company's weighted average cost of capital. That is possible. Because if the risk of this project is similar to the ongoing projects, then WACC is fine. We can use WACC. And then we can also adjust the rate for risk. Let's say, normally we discount a project at 6% rate, but if the risk of the project is higher than our regular projects, we may revise the rate upwards. Or if the risk of this new proposed project is less than the current projects that we have undertaken, so we might bring it down to just 4%. So we can incorporate the risk element into our discount rate just by increasing it for higher rate, for higher risk, and lowering it when the risk is lower. There are certain limitations to this DCF model. We may have to use a single rate, which is a limitation, but we will see in our subsequent slides that we can change rates on a yearly basis. What the actual limitation is, that the rate that we might have used in our evaluation, it may not be appropriate. Why? Because the risk may have changed over the period. The desired rate of return may have changed over the period. So this is the limitation, that we use a certain rate which may not be what the rate we should have used. Next, we have the net present value method, NPV method. This is a very important area. How do we calculate NPV? We just discussed that we will be calculating the present value of inflows, present value of outflows. So NPV, basically net present value, is the difference between the present value of inflows minus the present value of outflows. Sometimes this is the initial investment that we have made. So present value of inflows minus present value of outflows is what you call the net present value. So objective of calculating net present value is to help us decide whether should we invest in these projects or should we not, right? So it's a good method because the return of NPV method will be in dollar terms, not in percentages, not in the years payback. We'll discuss it in our next module. So remember, it's a good approach to calculate, to assess the viability of the projects, because the return is in dollars, not in percentages. So this would give us the absolute increase in the shareholders' wealth if we select a certain project with higher inflows and the lower outflows. And it gives the result in dollars, not in the years like we use in the payback method. So how do we calculate NPV? I've just told you, we estimate the cash flows at the start, yearly cash flows, and the terminal cash flows. We calculate the present value of inflows versus the present value of outflows. And then this net result would help us decide by comparing that whether should we invest in these projects or in this particular project or should we not. This is something very important you must remember. Depreciation does affect your capital investment project because depreciation is tax allowed expense. It is tax deductible. We have already discussed this concept. But whenever you see interest element in any capital investment project, remember interest expense is ignored. Why? Because the discounting process we use, it incorporates the impact of time value of money. So interest expense is to be ignored because discounting process deals with the cost of financing of the project. So this is to be ignored whenever it is given, right? So after we have discounted the cash flows, present value of inflows versus present value outflows, then we compare these two. And remember, it's pretty straightforward. Whenever the present value of inflows is greater than the outflows or initial investment, that means your project is desirable. So here we have summed up interpreting NPV. If the NPV is positive, which means if the present value of inflows is greater than the present value of outflows or the initial investment, then the project is desirable. You should make the investment. But if the other way around, if the present value of inflows is less than the present value of outflows, in that case NPV would be negative. So in that case, we should not make the investment. Now there is another concept we will discuss subsequently, limited versus unlimited funds. If we have unlimited funds, then you should invest in all the projects that can be taken. Like we take project A, B, C, D, all of them simultaneously. If you have unlimited funds, invest them in all if they have positive NPV, right? But if we have limited funds, then we may have to select only few out of them. Another important point you must note that there are two types of project, mutually exclusive projects and independent projects. Mutually exclusive means there are two projects A, B, only one of these can be taken. When it's either or, then we say that these projects are mutually exclusive. So select that project that gives you the highest NPV of these two. And if there are independent projects, which means all of these projects can be taken independently because they don't depend upon each other. So if you have unlimited funds, invest in all those projects with the positive NPV. If you have limited funds, then we will apply a concept called the capital rationing, profitability index, and then we rank these projects according to their desirability, according to their return, and then we make the final decision. So important point here to learn is that if the NPV is positive, go ahead. If the NPV is negative, then don't. And you must also consider these other factors as well. This is a good way to remember how we can proceed with these questions. Discounted cash flows is the basis for net present value method. First, calculate after-tax cash flows. We discussed in the previous slides. Then add depreciation benefit, that is depreciation tax shield. How is it calculated? Depreciation amount multiplied by the tax rate. We know what it is. And then multiply result by appropriate present value of an annuity or any discount factor. We will discuss this later. In other words, you need to bring those future cash flows into the present term, and then this is what you do. Present value of inflows minus present value of outflows. That is, subtract initial outflows, which is also called the initial investment, or the present value of outflows, from present value of inflows. And if the result is positive, go ahead. Else, if it's negative, don't. Okay, why I frequently refer to as present value of outflows? Because some projects may involve not only the initial outflow, but it might involve some net outflow in year 3, maybe $150,000. So in that case, you can't just say initial investment. You have to bring this T3 outflow in the present term also. That's why I call present value of all the outflows in the project. That is more appropriate. But mostly the projects you will come across on your exam or in the questions, you will have a single cash outflow at the start, and all the subsequent years will show a positive net cash flow. But if there is any negative cash, any outflow in any year, then you need to keep your outflow separate, inflow separate, and then you compare your present value of inflows versus the present value of outflows, and then you go for the final kill. Next is interest rate adjustments, mean the adjustment to the discount rate we will use to bring our future cash flows into the present terms. Now, what alternatives we may have? We can take just your current cost of capital, COC, the cost of capital, if you think this is appropriate. Or you may select some minimum rate desired by the management. Any rate arbitrarily selected by the management, 6%, 5%, the management selects so. If the management says so, we have to use that rate. So it could be some minimum desired rate of return. It could be any arbitrarily, any rate the management just want to use. We can take that. We can take the interest rate on opportunity cost. We can embed some risk in our interest rate. If the project is risky, we will revise our discount rate upwards. If the project has less risk than our comparative projects, then we may reduce the desired rate. And also remember, we need to factor into inflation as well. What is inflation? Inflation is the persistent increase in general price level. Your cost of production will go up. You may have to pay more for your operating cost, and this will affect your cash flow. So we may have to incorporate our impact of inflation as well, because rates may be revised upwards to compensate for expected inflation. So these are the elements must be considered. Let's take this illustration. Management would select a high hurdle rate for certain projects to factor risk into its consideration of acceptance of those projects. When a project has higher risk, it should be discounted at a higher rate so as to compensate for the higher risk. The higher hurdle rate discounts or reduces the future cash flows more, creating a smaller present value, of course. Remember, this is an important point. Higher the discount rate, lower would be the present value of inflows, which stands a larger chance of yielding an NPV below zero. with the project not being selected. So when you select a higher discount rate because the project is risky, then project must return significant returns so as to make it viable, right? So what we are doing basically, we are devaluing the cash flows. We are charging more discount factor so as to bring the project, or in order to make the project acceptable, it must generate higher returns, right? So as to bring in the risk into the picture. NPV model in this case would incorporate the risk into our computations. So just the key point here to remember, when the project is risky, discount rate must be higher so as to compensate for the high risk. Project must return more cash, and if the project has less risk, then we can use a lower discount rate as well. Yes, this is also an important point here to remember. We can change our discount rates for different years. Like let's say a project has a 4 years lifespan. Now T1, T2, T3 and T4, right? So just by using a single discount rate, we can find NPV. But if the risk of the project is very high in the early period, so we might take a higher hurdle rate for discounting purpose. But in the later period, the risk will smooth out. There will be low risk, so we may lower down our rates accordingly. So you can use different rates for different years, keeping in mind the different types of risk we are facing in these 4 years, right? And as we have discussed that we need to incorporate the impact of inflation in our computation also, because inflation affects cash flows. So it must be accounted for through higher discount rate. Now here is the important aspect you need to be familiar with. Certain projects are subject to specific financing rather than your conventional capital budgets. So in such situations, like investing in some green technology, so in such situation, the discount rate we use should be the after-tax cost of borrowing. Let's say if the cost of borrowing is 8%, so the rate that we should use is 1 minus 40%, so it's going to be 4.8%. After-tax cost of borrowing, it is sometimes called the incremental borrowing rate. This is the rate we should use for evaluating projects that are mandated by technology or maybe funded through specific source. Okay, now here this illustration that explains the idea of inflation. Assume that management anticipates higher than normal inflation. To compensate for the falling value of the dollars, it anticipates from its cash flows the interest rate or the discount rate may be increased, right? That's what we do. In order to incorporate inflation, the discount rate is increased. Okay. NPV method of capital investment valuation is considered to be superior. This is an important point, pass key, to the internal rate of return, payback, discounted payback. We will discuss these in our later studies. So it is considered to be the best method because it is flexible. It is flexible enough to handle inconsistent rates. Maybe we have a different discount rate for first 3 years, then a higher rate for the subsequent 4, 5, 6, 7 years, and then we bring it down to 5%. So this is an important feature of NPV computations. We can handle inconsistent rates of return for each year of the project by using the varying discount rates. Next, advantages and limitations of capital budgeting. Advantages. Flexible, yes, we just learned that it's flexible. We can accommodate varying interest rates, discount rates for different years. This is widely used method for capital investment decisions. It is the best, yes. This is considered to be the superior method for investment evaluations. What are the limitations? No percentage return. What you get is the absolute dollar amount, which is good, by the way, but sometimes it is difficult to explain to the management. Percentage is easily understandable, but dollar-based NPV is sometimes hard to explain. It is complex, no doubt. You need to bring in time value, money, incorporation, discounting. And the other limitation is that the target is only the set percentage discount rate, the hurdle rate, whichever the management might have selected. Next, we have capital rationing. Capital ration means we have limited investment resources, so we can't take all the projects. If you have unlimited capital, do all the projects with the positive NPV. All those projects that are independent, means A, B, C, D, they can be taken on independently. They don't depend upon each other. So invest in all those projects that are independent with the funds available. And mutually exclusive means either you take X or Y, you don't take them both, right? So the idea is when you have unlimited funds, invest in all those projects that have higher NPV, positive NPV. And in case of mutually exclusive projects, select the one that's giving you the higher NPV. But if you have limited funds, we cannot invest in all, then we rank, we prioritized. We use a concept called the capital rationing. Means we have limited capital, we can't invest them all, so we will use a technique called profitability index. What is profitability index? It's a tool we use for project ranking. What it does for us, it calculates the present value of per dollar of investment, return per dollar invested. We can use this number, the profitability index, to rank our projects, and then this will help us decide which product should we take. Let's take an example here. We have these 5 different projects with the initial investments given. What we have done, we have calculated their present value of inflows. These are the present value of their future inflows. Now we will use the profitability index formula. We will divide the present value future inflows with the initial investment. These are the results we'll get. Now this is the first step. You will calculate the profitability index, the first step. The second step is to rank them from the highest profitability index to the lowest. So as you can see, the highest is for B. This is going to be the first priority. Then we have E. This is the second priority. Okay, then we have A. This is going to be our third priority. Then it's going to be D, fourth, and if any funds are left, then we might go for project C. This is the fifth priority. So this is the second step. Calculate the profitability index, first step. Then you rank according to the profitability index. In the third step, you need to see what is the total amount available. We have just $50,000. Then we need to see how I can combine these projects so as we can take on all these projects within 15,000, and at the same time we get the highest NPV. So if you do little computation, you would that out of the funds available, we can take on B for 4,000. We can take on E 25, 29, and we can take on A 16, because these are the best projects we have. So they are possible to be undertaken within the funds available, and they also have the highest profitability index. This is how we rank, and this is how we select projects from different projects when we have limited funds. That's all for your M8 Financial Decision Models Part 1.